Mr. President, I ask unanimous consent that the quorum call be vitiated.
Without objection.
Mr. President, I come to the floor this afternoon to talk about the bill before us, and I want to commend my colleague and the chairman of the Senate Banking Committee, Senator Dodd, for his leadership on this crucial reform. And I want to start off by reiterating what I know many of my colleagues have said, that this is a strong bill, and it is a necessary bill. There's no doubt that we need Wall Street reform, and we need it now, when tens of millions of Americans have lost their jobs, homes, and savings. Americans can't wait any longer to end the reckless Wall Street practices that cause those problems. And I certainly never want to see us be in a position where we had the chairman of the Federal Reserve come to us about a year and a half ago and say to members of the Senate Banking Committee, if you need to act because financial institutions are on the verge of collapse, and their collapse would create a consequence to the national economy of enormous proportions. And I never forget the dialogue that took place there. In essence, when the chairman, Bernanke, was asked, the chairman of the Federal Reserve, what happens? Don't you have some time, enough tools of the Federal Reserve to get us through this period of time? He basically said, if you don't act, you'll have a global economic meltdown, which really means a new depression in the 21st century. And certainly a depression in the 21st century is much different than the depression that this country lived through under President Roosevelt. And since he was someone, or is someone, whose expertise is in Depression-era economics, how we got into the Depression, what made it worse, how we got out of it, it was a pretty compelling set of arguments. So here we are, and what we want to do is to make sure that we are never put at that risk again, that there isn't anything as too big to fail, because in doing so, you can make all the wrong decisions, knowing that even when you make the wrong decisions and they're risky, at the end of the day, the taxpayers will have to bail you out, because we can't have the country's whole economy go under. And at the same time, try to strengthen our regulatory process so that we not only not face that reality, but we create clear rules of the road. I'm for a free market. I believe in a free market. But there's a difference between a free market and a free-for-all market. And there's a difference between when someone takes their own capital, whether as a company or as an individual, and makes an investment, and when the investment goes good, they collect on it, and good for them. But when the investment goes bad, we all have to pay for it. And we cannot have a system where profits are privatized, but losses become the general public's responsibility. And that's, in essence, the core of what we're trying to do here, to make sure that such a system, which is what we've had, not a free market, but a free-for-all market, gets changed so we never face that again. So, as I've said, I think this is an incredibly strong bill, but even a strong bill can have suggestions to make a good bill even stronger. So I want to commend Chairman Dodd for being open to ideas to make this bill even stronger, regardless of which side of the aisle they come from. Now that we have broken the Republican logjam that has been holding this bill up for over a week, I hope we can get to the business of fully legislating and a full and open debate. I know that's what the American people want and expect, that the senators whom they send to Washington actually get to work on the business of fixing these problems, not that they sit on their hands while one party holds up debate because the bill didn't do everything they wanted it to, or because we had conversations, some of our colleagues on the other side of the aisle had conversations with Wall Street, and basically they don't like a lot of what we're doing here. But in fact, it's critical to the nation's economic security. And so I'm glad to see that we have colleagues now on the train. I just hope people don't try to pull the emergency brake switch to try to stop us from going to where we need to go. So I think this is a great bill, but there are some amendments that I plan to offer to the bill. I think they make the bill even stronger. I have filed an open books amendment to require companies to be more transparent in their financial reporting. Many experts believe that one of the reasons we got into this mess in the first place was because no one, not investors, not regulators, not counterparties, not even the people running the companies, could actually figure out the true value of these big Wall Street banks. That because banks hid a significant percentage of their liabilities, their risks, off their balance sheets. For example, Lehman Brothers treated $50 billion in repurchase agreements, transactions as sales, instead of financing transactions on their balance sheets, misleading everyone about the state of Lehman's finances. Bottom line is, it may sound very technical, but if I can take my liabilities off of my personal balance sheet and put them somewhere else and look like I'm better off than I am, that's fundamentally wrong. Clearly, had there been more transparency, we might have dealt with the Lehman situation sooner, thus reducing the repercussions of a catastrophic bankruptcy. The amendment I'm proposing is simple. It requires companies that are designated as systemically risky to disclose all their off-balance activities in their annual 10-K report to the Securities and Exchange Commission and provide detailed justifications for why they are keeping those liabilities off their balance sheets. It also requires disclosure of daily average leverage ratios in quarterly reports. This will prevent companies from moving liabilities off their balance sheets only days before when they are reporting earnings, as Lehman and others allegedly did. It's a step towards transparency. We know capital markets work best when they are transparent. That's the thrust of what this bill is trying to do. Put simply, the largest banks should not be able to deceive regulators, investors, counterparties, and the public by hiding their liabilities in off-balance vehicles. We need transparency and clarity, not trickery and deception. I also am happy to join with Senator Akaka, who is leading on this particular amendment, but I'm his prime co-sponsor, to require stockbrokers to act in the best interests of their clients. What a revolutionary concept, that stockbrokers act in the best interests of their clients. Brokers aren't required to act in the best interests of their clients and can sell clients worse investments because they make more money on them without the client ever knowing it. Brokers are only required to have, quote, reasonable grounds to believe that a product they are recommending is suitable for the customer, even if it's not the best product for the customer. Typically, brokers do not have to make disclosures about conflicts of interest or past infractions. In contrast, investment advisors, they're legally and ethically bound to put a client's interest ahead of their own. In essence, to have a fiduciary duty and to fully disclose those conflicts that they may have. All brokers currently have exactly the same conflict of interest that Goldman Sachs had in its civil fraud case by the Securities and Exchange Commission. Financial incentives to steer clients towards bad investment products that brokers made more money on. But retail investors are confused. They commonly think the services that investment advisors and brokers provide are nearly identical. An SEC Commission study in 2008 by the Rand Corporation found that investors were confused about the differences. So I don't think we need further studies. Senator Akaka's amendment and mine would end the confusion. It would require brokers to act in the best interests of their clients, just like investment advisors already do. It requires brokers to disclose conflicts of interest, so brokers would have to tell retail clients if they get more fees for selling a particular mutual fund or annuity product. And it gives the SEC discretion to apply a fiduciary duty standard for all types of investors which would include institutional investors who were victimized by the allegations in the Goldman Sachs case. Investment advice should be transparent. If there are conflicts of interest or higher fees for particular products, investors should know about it. Investors need to know that brokers have a duty to act in their best interests. I also have an amendment to expand the opportunities for women and minorities in banking. Currently, the staff of financial regulatory agencies lag in diversity. According to the Office of Personnel Management, minorities comprise only 18.7% of financial institution examiners. Women comprise 34%. Well, a recent GAO report found that among minority banks, only about one-third thought their regulators were doing a good or very good job of making an effort to protect or promote their interests, and less than a third of minority-owned institutions have utilized services offered by the regulators in the last 3 years. Only 5.7% of African-American firms and 5.6% of Hispanic firms obtained bank loans to start their business, compared to 12% of non-minority firms. The amendment I'm proposing would just rectify this by creating the offices of women and minority and women advancement at all the major financial regulatory agencies. These offices would be responsible for all matters of diversity, including diversity in agency employment and contracts. Office directors would provide annual reports to Congress on diversity issues with recommendations for improvements. And the amendment would also require publicly traded companies to provide in annual SEC filings diversity report cards, which would break down by gender and race the percentages of officers and employees who are minorities and women and the percentage of total compensation they receive. And finally, it extends the minority banking requirements under Section 308 of the Financial Institutions Reform, Recovery, and Enforcement Act to the Federal Reserve and the OCC. This similar amendment has already passed the House of Representatives unanimously, and I would certainly hope that we could do that same here. Diversity within the federal banking agencies will help ensure different perspectives are being brought to bear on issues and enhance the likelihood these solutions will be comprehensive and inclusive of a broad range of views. It will make our banking system fairer, more stable, and more just. Now, I also have an amendment with Senator Merkley to prohibit corporate executives and highly paid employees from hedging against any decrease in the market value of their employer's stock. This amendment is one that I think is very important because I'm concerned that there are a lot of bad incentives undermining the goals of executive compensation. A recent study found that there were at least 2,000 cases at 911 firms over an 11-year period in which executives tried to profit by betting against their own company. Hedging undermines, in my mind, the whole point of incentive compensation, to make sure that executives only benefit when the company does well. If they can hedge their stock, then it doesn't matter how well the company does, because either way, the executive makes money. Tails, they win. Heads, they win. That's simply fundamentally wrong. Worse, it may in some cases give executives an incentive to sort of like throw the game, to use their privileged position to take a position that may very well not be in the company and its employees' best interests, and then make a killing by selling the company stock short. Not good for the company, not good for the employees, not good for investors. My amendment would place a ban on stock hedging by executives and highly compensated employees, namely those making more than $1 million per year, preventing them from betting against their own company. Put simply, executives and highly compensated employees should never have financial incentives to act against the best interests of their very own company. And finally, I'm hoping some of these may very well be able to see its way into a manager's package. I hope we don't have to come to the floor to offer all of them. the recession's hit everyone, and community development financial institutions have been hit hard, especially hard. They're in a tough position because they've got to rely on the big banks for capital, which is neither affordable or easily accessible. My amendment would authorize the Treasury Department to guarantee bonds issued by qualified community development financial institutions for the purpose of community and economic development loans. This is also no cost to the taxpayer to do this. CDFIs have a proven track record of job creation and community development. They are the most effective way to infuse capital in low-income communities because the capital goes directly into those communities in economic development efforts. In focusing on the finances of Wall Street, I think this is an opportunity not to forget about the finances on Main Street, where most of the jobs are, and the devastating impact that Wall Street's actions have had on Main Street. And lastly, I'd like to talk about whistleblower protections. They're the first and most effective line of defense against corporate fraud and other misconduct. Yet because of inadequate protections against retaliation, would-be corporate whistleblowers often keep quiet when they could be protecting the public from illegal activity. As we've seen in the emerging Lehman Brothers scandal, a whistleblower who tried to alert management to illegal accounting tricks was fired. Through the Sarbanes-Oxley Act of 2002, they did much to expand protection of corporate whistleblowers from retaliation, but it lacks several modern whistleblower protections that have been standard in every piece of legislation since 2006. My amendment updates Sarbanes-Oxley protections against retaliation by giving whistleblowers 180 days to file a claim instead of the 90 that exists right now, giving whistleblowers their day in court with a clear right to a jury trial, clarifying that whistleblowers are entitled to compensatory damages, strengthening due process rights for whistleblowers by eliminating inconsistencies in current law, preventing employers from gagging whistleblowers by holding them to contractual obligations, ensuring that whistleblowers will be protected for all disclosures of material misconduct. We think that those opportunities strengthen a citizen to be able to engage and to come forth in a way that protects the company, that protects the investors, that protects all of us in the economy at large. Mr. President, again, I want to commend Chairman Dodd for his leadership in this effort. I've been a pleasure as a member of the Banking Committee working with him on some of the underlying provisions that he's already included in the bill that makes it so strong. I stand ready to work together to address these remaining issues, some which I hope we can work through and get accepted. Others which, if necessary, I'm ready to come to the floor and seek to offer. And finally, at the end of the day, I want a bill that puts New Jerseyans in a position in which, and all Americans, in which they will never be asked to reach into their pockets to take care of the excessive decisions of companies that privatized the profit, but then said when it went bad and the gamble didn't go well, that all of us should pay. We can't have that. That's what the core of this bill does. That's why I've been proud to work with the chairman. With that, Mr. President, I yield.
Mr. President.